incomes can only rise so much so quickly. And then with prices, yeah, we've seen it soften and go down in some markets, but in a lot of markets, it's still fairly tight.
Mm-hmm.
And you don't have a lot of these distress sales and stuff that would bring down prices. So I think with affordability in 25, 26, 27 nationally, affordability is still going to be an issue. It's just where the market is.
Lance, I am so excited to talk to you today. You started Resi Club and have incredible insights on the real estate market. But before we get started with what you are tracking in the real estate industry with Resi Club, go ahead and give us a little bit of background on yourself.
Yeah, so longtime data and financial journalist. Worked at publications like Bloomberg, did their best business school rankings, was at Fortune magazine. I had a data newsletter that would go out to Fortune 1000 executives. And then I had spent some time at Realtor.com for a couple years. I was going to leave journalism and become a data scientist. And when I was there, all of my, courses that I was taking outside of work and all the analysis that I was doing, I was using real estate data, right? So I got really intimate with, zip code, county, metro level, inventory data, pricing data, days on market. I was doing all these different analysis on it, started to understand a lot of different trends that don't even get talked about with real estate. And when I was like, you know what, I don't want to become a data scientist. It's too deep into my own head, like too much data. I kind of want to go back and do a little more of the hybrid of the in-between where it's more data storytelling. Like, how can I take this data, really simplify it, and people look at the chart or whatever I'm presenting and they're like, I get it. I understand the story. And so I went to Fortune. I was there 4 years. Like I said, did a data newsletter for Fortune 1000 executives. Then COVID-19 hits. Housing gets crazy. And just on the side, I started tweeting about housing and writing a housing story here or there. And because people were really hungry for better information on housing that wasn't a lot of this national news publication stories, right? And so my story started to really, resonate with readers, and I started to build an audience. And, I kind of grew up my Twitter following at News Lambert for housing. And at some point in 2023, I was like, you know what, I'm going to launch my own thing, news and research outlet. I want to play on my own terms, do media how I want to do it. And that's why I started Resi Club. And I'm just building an audience of, investors for single family, realtors, loan officers, home builders, land developers, SFR, build to rent, just across the housing sector, trying to give people good insights.
That's great. I have so many questions for you right now. I'm going to start. I know nationwide overall, there's it's only so valuable because I do want to get into specific cities and trends that you see for real estate investors to follow, especially if they want to invest in places that are not their backyard. But go ahead and just walk me through what has happened in the past 2 to 3 years, and what do you predict will happen in the next 2 to 3 years that are instrumental for real estate investors out there looking to either purchase single family homes, multifamily, or maybe something along the commercial space?
Yeah. So if you zoom out and you go all the way back to 2020, something very interesting happened for housing. And with housing, the actual supply of housing is not what economists would call elastic. And elastic means it can change very quickly. Mm-hmm. And so supply, the total housing stock, cannot move very quickly. A lot of the stock is 50 years old, 70 years old, even in some places 100 years old in the Northeast and Midwest. And so it can't change quickly. But housing demand is very elastic. It can be very elastic. And during the pandemic, you saw a huge acceleration in housing demand. Some of that was work from home. People who, were living in New York City, San Francisco, Seattle, could go and, take those higher incomes and go buy in other places like Boise, Austin, what economists would call work from home arbitrage. So that occurred. Then even the markets that lost people, New York, San Francisco, Los Angeles, Seattle, even in those markets, there was still an acceleration for demand because there was an increase in household formation as there was an elevation in demand for space. So roommates who in New York, for example, maybe see each other 2 or 3 hours a day, right? Started to see each other 16 hours a day.
Yeah.
And they were like, you know what? Because they're working from home. And they're like, you know what? I can't stand this person. And, with the stimulus money and, stocks and assets ripping, there was a lot of a increase in the household formation, 1 million more than you would expected, right? And so that increased demand for space, even in the markets that lost people. Then there was the stimulus money and the ultra low rates that came into the market, right? As well. So it increases cash flow, prices are ripping, rents are ripping, more investors are piling into the market. And the Fed estimates that during the pandemic housing boom, housing starts would have needed to increase 300% to absorb the increase in housing demand. So that would be going from 1.4 million housing starts to 2.8 million, which is a 100% increase. Yeah. Then going up over 4 million housing starts, which would be a 200% increase.
Possible.
And then going to like over 5.5 million to absorb it. It cannot happen. Supply is not elastic like that, right? There's the supply chains, the window, the lumber, the labor market, right? Only so many people know how to do all of the different things that go into building a house, right? And it takes time to teach people. So supply isn't elastic. And because supply could not absorb demand, what happens in economics is prices overheat, right? Not all of that demand can get into the market, right? And so who gets to actually transact, the demand that gets to transact is the demand that will pay the most. So prices overheated. And so during the pandemic housing boom, within 18 to 20 months, home prices went up nationally 38, 40, 42, 45%. It soared up. And in some markets went up 60%, 70%. And in some Sunbelt zip codes and neighborhoods, it went up 80, 100%, right? And so immediately that was followed by a rate shock, right? Because we had this inflation, we had the housing inflation. And so a rate shock occurs as the monetary policy meets where where the market had went for inflation and where the market also for labor because it was so tight. So rates shoot up. We go from a 2.6% 100-year low for the 30-year fixed mortgage rate in January 2021 to in June or in 2022 is really when it really started to go up, and it goes from 3% to 4% to 5% to 6% to 7%, and the market absorbs this historic shock to rates. And there's also the other affordability hits from insurance and property taxes, which are all lagged from the prices because those take time to feed in. And when you take all of this, when taking into account home prices, when taking into account mortgage rates, and when taking into account incomes, we've deteriorated to a 40-year low for affordability. So a very big shock. We go from one of the most affordable periods ever for housing, the 2010s decade. And we were in a very affordable place in 2010, nationally speaking. I know people in California would argue with you, but nationally a more affordable market to very quickly a 40-year low for affordability. And so the big impact there, and this is true everywhere in the country, anywhere you go, is that existing home sales are very suppressed. And so while prices have been stable, actual existing home sale transactions have been very low. And the reason is you've taken a particular part of the market, what I would call churn part, where somebody has a house, they sell it, and they go buy something else. That particular transaction, right? Selling it to go buy something else because they want to do it for lifestyle or whatever. Yep. That's pulled way back because people are like, wow, I would go from X payment, X rate to X payment, X rate. And it's like, for some people that could be $800 more. It could be $1,500 more. It could be $4,000 more, depending on what price we're talking at. And you have it to where some people who would like to downsize, get a smaller home, would be paying a bigger payment. Right? And so it's just taken a piece of the market for transactions and pulled it way back. But the story for pricing is varied a lot more, and we can get into it by market and what's kind of happening there, because some markets have stayed, despite everything that's happened, they've stayed very tight for active inventory. And then you have other markets, and we could get into what's driven it, where the supply-demand equilibrium has moved into place, where prices have kind of softened or even maybe declined a little bit.
Yeah. So the lock-in effect is real. What are you thinking for the next 2 to 3 years. I mean, you just spoke about, which I think is fascinating, that we're at a 40-year low for affordability after being at such a high and getting shocked by interest rates with still prices remaining very high. What do you think is in the future? And predict beginning of 2026, 2027. And do you think anything will give, and will prices give at all?
Yeah. So with affordability, unless the economy were to really weaken and the labor market, we would start to see unemployment shoot up quickly. The financial markets for the long-term rates are probably going to stay high relative to where we've been. The 6.5%, 7% mortgage rate. Yeah, maybe we get the spread down a bit. Maybe it gets down to 6, right? Maybe it gets to high fives, but that's a lot of speculation, right?
Yeah.
And so even if that did happen, affordability would still be constrained. And on the other side, incomes can only rise so much so quickly. And then with prices, yeah, we've seen it soften and go down in some markets, but in a lot of markets, it's still fairly tight.
Mm-hmm.
And you don't have a lot of these distress sales and stuff that would bring down prices. So I think with affordability in 25, 26, 27 nationally, affordability is still going to be an issue. It's just where the market is.
Yeah.
And so with transactions for resale and existing homes, I think over time, because think of it, the lock-in effect like a switching cost, right? You're going from one rate, one payment to another rate, another payment, right? And initially, right out of the gate, when rates shot up, the lock-in effect would be the strongest, right? Because right then, when it went from 3% mortgage rates to 7 in 2022, that's when that payment shock occurred, right?
Yep.
But over time, as people's incomes can rise, and then the psychological side for switching costs, maybe you have another kid. You're in a 2-3 bedroom house and you go to 3-4 kids, right? And your spouse is starting to get a little unhappy with you because they're like, hey, we really need more rooms for these kids. And that starts to be a psychological cost, right? Where that person is like, you know what? Yeah, that difference for the payment sucks, but because these psychological costs for me are starting to mount, or I need to move to be a little closer to work, they might be more willing to do it, right? And so I think over time, and if you can get incomes to rise, maybe even rates come down a little bit, that switching costs will slowly become less of an issue for the housing market. And so we saw this in 1978 and the late 70s when rates shot up a lot during that inflationary period. And we got to 18% mortgage rates in 1981. What occurred is the high from existing home sales in 1978, it took 12, 13 years to get back to it. Right? It took a long time. And so I don't think it'll, I wouldn't even use 2021, that high 6.1 million existing home sales. I wouldn't even set that as a target to get to. But I think a target of like 5.3 million existing home sales that we saw in 2017, 2018, 2019, I think over time we will grind our way back there, but it's going to be a grind. And right now we're at like 4.1 million existing home sales.
Yeah. And it's such a good point. History repeats itself, maybe not to the extent of those great inflationary years, but history does repeat itself. And then you also mentioned at the beginning of real estate, things happen very slowly. It's not, you can't adjust things very quickly. And so I think it's very well taken that this affordability problem and people getting locked in to their existing rates and not being move-up buyers is a real problem that we'll see. I want to talk to you also about just real estate investing in general. So knowing this and knowing where we are, and it takes a while for things to change, do you think right now is a good time to buy a rental property?
So I think with the rental property investments, a lot of it comes down to cash flow, right? Where are the places that you can still find cash flowing properties? And there are markets out there, and there are places where that is still there, and there are still segments of the market. And so those are the places, when I peel back the data, that I still see investors buying. Mm-hmm. It's a lot of these lower cost, small, mid-sized, Midwest, Northeast markets that have stayed fairly tight, still have appreciation, still have a good number, or still, rental yields. You can kind of still find them. And so there's still investment there. And if you look at like a lot of the institutional investors, they have pulled back from the markets because they have a harder time making the numbers work when you take in prices, when you take in where the rate environment has got to, where you take into effect where maintenance has got to, and all of that. But it's because they are, the institutional side, competing against yields across the financial system, right? So when institutional capital deploys, it's not just looking at, can I make the numbers work for single family? They're looking at, how does that compare to multifamily? How does that compare to industrial? How does that compare to, different segments of the economy that are out of real estate, right? For yields. Like right now, the 10-year treasury yield is like at 4.5%, right? So treasuries become competition for institutional capital. But that also means that some of the smaller investors, they're not playing against as many of the big dogs, right? And if they can find arbitrage in the market where they know their niche, they know their market, there's opportunities, right? Still out in real estate today.
I'm going to ask next, this is great, the question that I'm sure all of our listeners want to hear. Where are these markets where you can cash flow? What are some of the markets that you are seeing that maybe an investor should double click into?
Yeah, so when you look at the data, the places that still have appreciation, still have like gross yields that investors can find, you'll see places like Buffalo. You'll see places like Rochester, New York. You'll see places like Pittsburgh, Cincinnati, pockets of Indianapolis, maybe even like Toledo, some outskirts areas of Chicago, although that becomes a whole other issue because Illinois, has property tax problems and stuff like that. They can become a risk. And those are also markets that not only are they very tight for active inventory and prices are rising, but they have less of the risk from the insurance side, which we could get into later if we want to. And so less of a risk for insurance shocks in the coming years.
I'm so glad you just brought up insurance. I have a couple of questions. So you didn't mention any Sun Belt states. Talk a little bit more about why those may not be as great of an opportunity, and then talk about insurance. And I'm going to bundle those two together because I recently was talking to Darren over at Steadily, and he had mentioned the number one on the insurance side that people don't think about is not hurricanes or fires, which has been in the news, but actually hail. And so it's interesting because some of those cities you mentioned, I would assume have a higher chance of having hail than Los Angeles or the Sun Belt states. But talk to me a little bit more. What's going on with insurance with these markets and what's going on with those markets, the Sun Belt states in the South, more recently?
Yeah, so the U.S. housing market has passed through and is still passing through in some parts of the country what I would call a home insurance shock, right? And so a lot of this is driven by replacement cost and construction costs going up so much. During the pandemic housing boom, home prices go up 40, 50% in a lot of markets. Construction costs also went up in a lot of parts of the country, 40+%, right? And so when you do have a damaged property, it costs a lot more to replace it, right? The replacement costs have gone up. And so that has to feed into insurance. So you have this housing and construction inflationary shock, and it takes time to feed over into insurance. So across the country, that's feeding into it. And that's why insurance premiums have still went up in a lot of pockets of the country that you wouldn't think of for home insurance, right? Going up, right? Because, the construction and replacement costs have went up so much. But there's other factors as well. And the risk scenarios for disaster and climate, all of that is feeding in. And there's been an increase in construction into the very particular parts of the country where there is the most disaster risk, right? So we build a lot of homes in Tampa, right? We build a lot of homes in Cape Coral. We build a lot of these homes around the Gulf and in the Southwest where more of this risk is. And so that also plays into effect. And so I'm close with a guy named John Rogers. He's the chief data and analytics officer at CoreLogic. And he has a team of 200 meteorologists and data scientists. And they analyze insurance for every individual residential and commercial property in the US.
Wow,
And that
every
data,
single one.
and so that data gets sold to insurance companies, right? So
Mm-hmm.
you can kind of see in some of their data, some of this risk and some of it going forward, and it's still going to be an issue for insurance. And then if you look at some other analysis by places like First Street, which I'm about to publish this data over at Resi Club for my pro members, it's the predicted increase in home insurance premiums for every county in the US for residential over the next 30 years, from 2025 to 2055. And a lot of their risk where, you could go up on a real basis 300% plus for insurance are going to be a lot of these coastal parts of Florida, right? And if you look at the data for a lot of these Midwest markets and some of these plain states, that's where there's much lower risk for the home insurance premium shocks.
That is super interesting data. So what you're telling me, Lance, is I can get from you what is an expected insurance premium and see it over the years for a particular market. So when I put together my pro forma to know whether or not this is a good market to invest in real estate, you can help me analyze that insurance cost, which right now I think most investors have as the one variable that could bring them to either cash flow or not cash flow. And because it's gone up so significantly, they've had to pull out thinking something was a good deal and it wasn't. But you now have this data for us.
Yeah, correct. And so at Resi Club, I have data stories looking at, where is home insurance premium forecast, right?
Mm-hmm.
I have forecast for regional home prices. I have, inventory looks across the country. For 800 metros, 3,000 plus counties. I do some zip code every once in a while, and I also have data on how much home insurance has gone up by county, right? Where it is by county, and then also, and this is a key number in my opinion, the non-renewal rate for insurance by county, because that's also suggesting more upward pressure on some of those counties as well.
Wow, that is incredible, because I haven't heard of anyone else who has this information. And also I find that interesting, you working with the CoreLogic team and talking to them about coming up with an insurance premium per property. Because one of the questions that I have is, hey, okay, I have a rental in, let's just say, the middle of Florida, which I have less of a risk of hurricane damage by the time it gets there. My understanding was potentially I would still have high rates because it's in Florida or in some certain kind of bundled location geography. But what you're telling me is insurance providers now can be like, no, actually, that property does not have as much risk as one in Tampa, and I could get a better insurance rate than the others. Are insurance companies doing that today where they're looking at it at the property level?
Insurance is going to get way more sophisticated.
Great.
It's going to get much more data driven. That's right. But now you're still not necessarily escaping that Florida effect. So
Okay.
if you look across Florida for home insurance premiums and for non-renewal rates, it's really shot up a lot across all of Florida. Now, that doesn't mean that home insurance is the same across Florida, because it's not.
Yeah.
But the shock of it has affected a lot of the state. But you will see more individualized stuff happening with insurance.
What about LA? Have you looked at all into after the fires and home insurance policies in California? And then how does the government even play a role or a factor in this with insurance, as it's a huge problem for everyone?
Yeah, so with LA and how this is going to play out with the fires, it's really hard to figure out, right? In terms of like the full effect, because there is the policy arm, right? Are they going to do things in in California, in Southern California, to help to accelerate, the building, right? Because California is one of the hardest places to build in the country.
Yeah.
Right. It's one of the places where it's the most cost for the builder, right? And so it'll be interesting to see if the political pressure there accelerates the building, right? And it speeds up that process, because there's going to be a lot of pressure to get this going fast. Now, the thing about Southern California is that it's been a fairly tight market, despite rates going up as much as they have. And a lot of that is due to the fact that the market just has a dearth of supply coming in. It's very inelastic for supply. There's not much building there, right?
Yeah.
And there's still a high demand to live in LA, right? Still higher incomes, right? There's still that high desirability, and there's not much elasticity on supply. And the other factor there is that you saw a lot of migration during the pandemic housing boom, right? As a lot of that work from home arbitrage. But since then, the migration out for California, while it's still high, a lot of Americans moving out of there, it's not what it was before, right? So there's more stability to the out migration of Americans there. And so the market is still fairly tight. And what you just did is you just took off a chunk of housing supply of actual homes in that market and just took them away. They're gone, right? And so now those people, they still have demand for space, right? They're going to need to live somewhere. And so it adds more supply, or it adds more demand, and it pulls back the supply. And it's going to create acute, in those specific regions, affordability pressures, right? In that competition for the market. And that's why you've already seen, things talked about in terms of like stopping, like rent gouging or prices going up. But there's only so much you can do to contain it. But there's going to be some pressures there because it occurred into a very tight market. Now, in terms of insurance, it's a little harder to figure out how that or one specific thing will play out. But you do see more upward pressure for California home insurance rates. And the state itself has fought off some of those increases from insurers because it has to be approved. And so what you've seen is a good number of insurers leave the state of California, right? And so there's still going to be more upward pressure on home insurance in California.
Yeah, that makes complete sense. I want to change topics here and talk about city versus suburbs. And the reason I'm so interested in it is, one, obviously remote work from home, people are going in fewer days in the office. And so willingness to work or live farther away from where they work is a factor. And then also just self-driving cars, I believe, will have a huge impact on where people decide to live, because now suddenly you can have an experience when you are on your way to work rather than sitting behind a wheel. And so I'd love to just hear a little bit more from you of what you're seeing with suburbs versus cities. And do you have any sort of projections for the future of what will win and really hit a home run with appreciation?
So when you hear about a metro area, right, a metropolitan area, which is calculated by census, really what that is, and I'm going to get to your question, and I'm just going to take time, but what that really is it's a job market and it's a housing market, right? And so how they calculate a metro is based on commuting patterns, right? Going from home, the housing market, to job, the job market, right? And so during the pandemic housing boom, when a lot of people were remote, you saw that disconnect a bit, right? And so you had the work from home arbitrage effect where a lot of people in like New York City are going to Austin or Boise. But as that has kind of pulled back a bit, right, and the work and return to work has gained just a little bit of momentum, what has occurred is you've seen less of the market to market work from home arbitrations slow down and stop, right?
Okay.
But what has continued is deep exurbs, right? There's still a donut effect in a lot of these bigger metropolitan areas where the person is like, you know what? I can't work remotely every day of the week. I'm not going to take this job and go live in Boise, but I might be able to go somewhere that I would have never wanted to commute 5 days a week, but I'll manage it 1 or 2 days going into the office, right?
Yep.
And so it opens up their personal buying box to go deeper out and try to hunt down affordability. And so what that's done is it's created this donut effect in a lot of metropolitan areas where the metros have been pushed further out to the edges, right, to try to capture some of that affordability. And we've still seen in places like, Philadelphia, Boston, New York City, Washington, D.C., these deep exurbs stay fairly tight. And I think, as long as, we don't see a lot more employers pull back to fully 5 days a week, you'll probably still stay fairly tight in those markets.
Yeah, it's such good insight. And also, I think when we just spoke about affordability and not seeing it for a while, this is a solution to get a little bit of affordability for at least primary residences, should we say. Lance,
And so let me interrupt you there.
Go for
so
it.
That is a very big point in this housing market where it's about relative affordability, right? So people are trying to hunt, because affordability is such an issue that everywhere you look, people are trying to hunt affordability down. So that's created trends like accelerating the number of smaller homes, right? Because people are just trying to get a little more affordability. Builders are trying to get a little bit more, right? And so it's the deep, deep excerpts, right? Where, people pushing out further, all of that, like that relative affordability. And that's also why a lot of these Midwest and smaller Northeast and mid-sized markets have stayed fairly tight, even though affordability is stretched there compared to where it was. For some other people, it's maybe not as bad, right? That relative affordability.
Yeah, no, and I love that you just clarified that there. Lance, this was incredible. I learned so much. Anything else that you want to share that you don't think we covered today on the housing market?
Oh boy, there's always so much with housing. It's one of those things that affects everybody, right? And there's so many people who work in the industry, invest in it. So if people want to kind of follow along and they like some of my data-backed trends, they could sign up for my free newsletter at resiclubanalytics.com. I also tweet out all the time on Twitter, it's called X now, @NewsLambert, and they can find me at LinkedIn too.
Great. Thank you so much, Lance.
Thank you for having me.